Silver just crossed $90 per ounce as I'm recording this on February 11th, 2026. But here's what nobody's telling you about what's happening right now behind the scenes. While everyone's watching the price climb, something critical is unfolding in the COMEX vaults. Registered inventory just dropped below 100 million ounces for the first time in tracking history. We are 16 days away from February 27th, the first notice day for March contract deliveries. And the math doesn't add up. The math has never been this broken in the history of silver markets. Let me show you exactly what's happening. Because this isn't about speculation anymore. This is about numbers that don't lie and a system that's running out of physical metal to deliver. The current price of silver is around $90 per ounce, up from yesterday's close. We've recovered from the crash low of $64 just 1 week ago on February 5th. That's a 40% bounce in 6 trading days. This is not normal price action for any market. Gold is trading near $5,030 per ounce, holding steady above $5,000. The gold to silver ratio sits at 56 to 1, down from 64 just days ago. Every time this ratio tightens, it creates mathematical pressure for silver to move higher. If gold holds 5,000 and the ratio compresses to 40 to 1, silver trades at 125. That's not a prediction. That's basic math based on historical ratio patterns over decades. Bitcoin is hovering around $70,000, up from the danger zone below $65,000. I've said this before. Watch Bitcoin because silver follows its momentum and risk on environments. Above 75,000 and we're clear. Below 65,000 and trouble returns quickly. Right now we're in the middle zone where anything could happen based on broader market sentiment. What's actually happening at the COMEX exchange is what should concern every person watching this. Registered silver inventory, the metal available for immediate delivery against futures contracts, is critical. The most recent data shows approximately 100 to 103 million ounces remaining. We have officially crossed below the psychological and structural threshold of 100 million ounces. Let me give you context that the mainstream financial media refuses to acknowledge or discuss. In October 2025, just 4 months ago, registered inventory stood at 167 million. That's a 40% decline in available delivery metal in 120 days of trading. The current drainage rate is 785,000 ounces per day based on recent trends. If this rate continues for 16 more days until February 27th, we'll have critical supply issues. By March 1st, first notice day, registered inventory could drop to 87 to 90 million ounces. The March contract currently has open interest, representing 425 to 455 million ounces. That's a 4.3 to 1 mismatch between paper claims and actual deliverable physical metal. Normally, 2 to 5% of open interest stands for delivery in any given contract month. That would be 8.5 to 22 million ounces, which the COMEX could theoretically handle. But we're not in normal times, and February delivery patterns are screaming a very different story. February deliveries are running at a 98% delivery rate as of the latest exchange data. Let me repeat that number because it's the most important data point in this entire analysis. 98% of February open interest is demanding physical delivery, not cash settlement or rolling forward. This is not a futures market anymore. This is a physical allocation mechanism operating under extreme stress. People are using COMEX to secure actual metal in their possession, not to speculate on price direction. If March follows February's delivery pattern, we're looking at demands of 200 to 300 million ounces. Available registered inventory sits at 87 to 103 million ounces by delivery time. The math doesn't work. The system cannot deliver what it has promised to deliver under current structure. And the market knows it, which is why strange things are happening in futures contract behavior. If this analysis is helping you understand what's really happening, hit that like button right now. Drop a comment with the words "silver squeeze," so I know you're following the data, not the hype. About 75% of viewers watching this still aren't subscribed to the channel yet. That engagement is what allows me to keep bringing you this level of detailed market analysis. Let's continue breaking down exactly what's happening and why this matters for the next few weeks. So why is silver rising right now if we're supposedly heading into a delivery crisis? Because this is exactly how these setups work. When silver hit $121 per ounce in late January, everyone was euphoric and bullish on the metal. Retail traders were piling in with leverage. Margin positions were at maximum capacity across every major exchange. Speculators were convinced silver would hit $200 by March based purely on momentum and sentiment alone. That's not when supply squeezes happen. Squeezes happen when weak hands have been completely flushed out of positions. The CME raised margin requirements 6 times in 30 days during late January and early February this year. That forced massive liquidations across futures contracts as traders couldn't meet the higher collateral requirements. Kevin Warsh's nomination as potential Fed chair created a hawkish narrative that the media amplified relentlessly. Chinese speculators unwound positions before Lunar New Year holidays, which is normal seasonal behavior in Asian markets. These are technical factors that have nothing to do with actual supply and demand fundamentals in physical metal. While the paper price was falling from $121 to $64, look at what happened behind scenes. The SLV ETF recorded massive inflows during the crash. With institutional buyers stepping in at lower price levels, recent data shows SLV had 5-day net flows of $2.44 billion during the crash period. That's not retail panic selling. That's institutional accumulation on weakness when prices are artificially depressed. PSLV doubled their equity program to $2 billion on January 20th, signaling major conviction in physical metal. At $90 per ounce, $2 billion represents approximately 18 million ounces of buying power. That's 16% of total COMEX registered inventory being targeted by a single trust for acquisition. When institutions compete for physical metal at this scale, their betting paper claims will lose all credibility. The Shanghai Premium tells you everything you need to know about the disconnect between East and West pricing. During the February crash, when Western Spot hit $72, Shanghai was trading above $90 per ounce. That's a premium exceeding $8 per ounce for physical delivery in the Chinese wholesale market today. Physical silver in China was trading at 45% premium, while paper crashed 30% in New York. Today, even as Western prices recover to 90, the Shanghai Premium holds at 8 to 10% stubbornly. That tells you the physical market and paper market are operating in completely separate universes right now. China implemented export restrictions on silver starting January 1st for strategic material classification. Shanghai Futures Exchange warehouse stocks are at 423 tons, near decade lows currently. When the world's largest industrial consumer restricts exports and maintains premiums that signal scarcity, silver lease rates exploded from 0.3% to 8% annualized during recent volatility. The exchange for physical spread on 1,000-ounce bars widened to $110 per ounce. Normal EFP spreads are $25. We're seeing a 4 times increase in securing actual physical bars. American Silver Eagles are selling for $95 to $165, a premium of up to 110%. Normal retail premiums are $5 to $8. We're seeing premiums 15 to 20 times higher than normal levels. The U.S. Mint still hasn't released 2026 Silver Eagles, with pre-sales scheduled for late February delivery. So here's what's actually happening while everyone watches the price movement on their screens showing $90. The structural deficit is in its 5th consecutive year. Mine supply physically cannot keep up with demand growth. 70 to 80% of silver comes as byproduct of copper, lead, and zinc mining operations globally. Industrial demand accelerates across every major technology sector requiring silver for electrical conductivity. Solar panels, electric vehicles, 5G infrastructure, AI data centers all require silver for critical manufacturing. Over 50% of annual silver supply goes directly to industrial use that cannot be substituted economically. For anyone holding physical silver long-term, today's price action changes absolutely nothing about the thesis. You're seeing paper recover while physical premiums scream scarcity across every single segment of the market. This is the exact setup that precedes explosive price moves when supply cannot meet actual delivery demand. The critical catalyst everyone needs to watch is coming this Friday, February 13th at 8:30 a.m. Eastern Time with the CPI report. Markets are calling this inflation's Friday the 13th, and the timing couldn't be more perfect for what's developing in silver right now. Consensus expectations are headline inflation at 2.5 to 2.6% year over year, down from 2.7 in December. Core CPI expected to rise 0.3% month over month, the number that matters most for Federal Reserve policy decisions. This is the first inflation test of 2026. It confirms or destroys the hawkish narrative Kevin Warsh's nomination created. If CPI comes in hot above 0.3%, the dollar rallies and rate cut expectations get pushed significantly further out. That's short-term bearish for silver, and we could see a move down towards $75 to $78 per ounce quickly. If CPI comes in soft at or below expectations, the rate cut narrative strengthens, and that weakens the dollar across all major pairs. That's bullish for metals, and we could see a breakout toward $95 to $105 per ounce within days. Markets priced in 58 basis points of cuts for 2026, with the first cut expected in June based on futures. Recent labor data weak across indicators. ADP at 22,000 jobs. JOLTS at 6.54 million openings. Jobless claims at 231,000. Elevated, but not yet signaling immediate recession risk or systemic breakdown. If CPI confirms inflation cooling despite weak labor, that's the green light for precious metals to run higher over coming months. The key is positioning before the data prints, not after the number hits Bloomberg terminals at 8:30 a.m. Friday morning. By the time the number prints and markets react, it's too late to get optimal entry or protect from adverse volatility moves. Bitcoin is currently trading around $70,000, right in the middle of the critical decision zone for risk asset direction. Below 65,000, and we're in trouble for all risk assets. Above 75,000 signals improving liquidity and capital flows. Right now at 70,000, we're in no man's land where either direction is possible, depending on macro catalysts like Friday's CPI. The March 27th timeline matters most beyond any short-term price action or volatility we see this week around economic data. We are 16 days from February 27th, the first notice day for March comics deliveries that everyone needs to watch carefully. Let me walk through what happens during March delivery because this determines whether the paper market maintains credibility or breaks permanently. On February 27th, longs wanting physical must notify the exchange they intend to stand for delivery instead of rolling forward. The exchange has through end of March to fulfill those delivery obligations with actual physical metal from registered vault inventory. Normally, this is a non-event, 2 to 5% stand for delivery, comics delivers from vaults, and markets move on without incident. But January 2026 saw 49.4 million ounces delivered, 7.27 times the 2024 level. 1 week in January saw 33.45 million ounces withdrawn, 26% of registered inventory pulled in 7 days. February shows a 98% delivery rate, meaning almost every contract holder demands physical metal instead of cash settlement. If March follows this pattern at 25% delivery demand, that's 107 million ounces against available inventory. If delivery demand hits 50%, we're looking at 213 million ounces demanded against existing registered supply. The inventory to meet those demands does not exist in registered COMEX vaults available for immediate delivery against futures contracts. Either COMEX delivers metal that isn't there, settles in cash, or declares force majeure and suspends deliveries under exchange rules. Any of those outcomes breaks the paper market permanently and forces price discovery based on actual physical metal availability only. I'm watching 3 critical indicators daily that will tell me exactly where this situation is heading before February 27th, first notice day. First, COMEX registered inventory updates every night at 9:30 p.m. Eastern on the CME website, where anyone can track the numbers in real time. If we drop below 95 million ounces before February 27th, that's a critical threshold that signals extreme delivery stress. We're currently tracking toward exactly that scenario based on the 785,000 ounce per day drainage rate we've been seeing. Second, Bitcoin price action matters because silver follows its momentum in risk-on and risk-off environments with reliable correlation over time. If Bitcoin breaks below $65,000, expect more selling pressure across all risk assets, including silver and industrial commodities. If Bitcoin reclaims $75,000 and holds above that level, that's the all-clear signal for renewed capital flows into alternatives. Right now at $70,000, we're in the middle zone where anything could happen based on broader macro sentiment and Friday's CPI. Third, the Shanghai Premium tells you whether physical tightness is real or whether pressure is relieving in the largest consuming market globally. If the Shanghai Premium stays above 10% over Western spot prices, that confirms genuine physical scarcity in the wholesale market. If it collapses towards zero, that tells us supply pressure is easing and the physical shortage narrative needs serious reconsideration. Right now, it's holding at 8 to 10%, even as Western prices recover to $90, confirming the physical disconnect remains. I'm also watching February delivery notices closely because any acceleration in the next few days signals front-running into March contracts. If traders don't trust metal will be available in March, they'll pull forward deliveries into February to secure physical before the crisis. That would be the canary in the coal mine, signaling that insiders believe the March delivery period will be catastrophic for the system. The technical picture for traders shows critical zones that matter over the next few days, based on support and resistance patterns. We're testing support at $85 to $87, which has been the stabilization zone over the past 24 hours. Below that, 81 to 83 becomes major support, where we consolidated before today's breakout movement to $90. If we break below 81 with volume, we could retest the $72 to $75 zone from last week's action. On the upside, $92 to $94 is immediate resistance based on technical analysis and prior price action patterns. We need to reclaim 94 with sustained volume to confirm the next leg higher toward the psychological $100 level. The 50-day moving average sits around $75, well below current price, confirming short-term bullish momentum intact. The 200-day moving average is at $49, confirming the long-term bull trend remains completely intact despite volatility. RSI on the daily chart is at 58, neutral to slightly bullish, showing room for continued upside without overbought conditions. COMEX open interest declining during the recovery suggests strong hands holding while weak hands got flushed out during the crash. Here's the bottom line. Beyond all the noise and short-term price action you're seeing on your screens right now today. Silver is at $90 as I record this on February 11th, recovered from the $64 crash low last week. But COMEX registered inventory crossed below 100 million ounces with 16 days until March delivery period begins. The math doesn't work. The structure is breaking. While paper traders chase momentum, institutions accumulated during the crash. This is how supply squeezes develop when physical delivery becomes constrained against outstanding paper claims in commodity markets. The squeeze doesn't happen when everyone's bullish at $121 with maximum euphoria and leveraged speculation. It happens when sentiment turns bearish, weak hands flush out completely, and the setup becomes mathematically perfect for repricing. March 27th determines whether COMEX can deliver or whether the paper market credibility breaks permanently and irreversibly. Either they deliver physical metal matching outstanding claims, or they settle in cash or declare force majeure under exchange rules. Physical premiums at 110%, lease rates at 8%, drainage at 785,000 ounces daily. Delivery rates at 98% in February, Shanghai premiums at 8 to 10%, industrial demand at 50% of supply. These are verifiable numbers from exchange data and market pricing that anyone can confirm independently through public sources available. The data says the lower this goes short term, the more explosive the move when supply cannot meet demand at any price level. Whether that means $120, $150, or $200 per ounce, the direction is mathematically clear now. For long-term physical holders, you're watching the exact setup that precedes the most significant moves in commodity market history. For short-term traders, the next 48 hours around CPI and 16 days until February 27th are absolutely critical. If this analysis helped you understand the real dynamics at play, drop a comment on what happens. March 27th, when deliveries hit. Hit subscribe, because when this market moves, you'll want real-time analysis of what's happening and why it matters for positioning. The physical shortage isn't coming. It's already here. The question is when the paper market admits it and reprices accordingly. Stay sharp, watch the data, and understand we're living through a historic moment in silver that won't repeat in our lifetimes.